So once again, my name's James Chaplin, and I'm the CEO of Vacancysoft. And what we are is we're data publishers. So we gather jobs that are being published on company websites. We are identifying when they're new, when they're not new. We're assigning data points algorithmically. We are then publishing them by email to our clients, and we're making the data searchable online. We're also then quality controlling the data and providing the data also in an analytics environment for our clients to use. We've been going a long time, actually, as I said earlier, and along the way, we picked up lots of lovely clients. Thank you all, clients: Michael Page, Hayes, Robert Walters, Adecco, quite a few big names there, but also right through the spectrum. And along the way, we do publish lots of reports and insights. So we've been featured in most of the major media. So you think you heard of us from somewhere, you probably have done. And in terms of today, what do I want to talk about? Well, I want to start by looking at the macroeconomic market, just the market in terms of the economics. You know, it's like there's a phrase I use, which is that recruitment is tidal. So what I mean by that is when the market picks up, recruiters do better. When the market sinks, it impacts the recruitment industry too. So let's just have a start point of looking at the economics, what's going on. Also, one of the big stimuli we see in the sector is what's happened with the VCP funding. So just to talk through that a little bit, looking at the London and regional splits, let's talk a little bit about skills and demand in terms of what we're seeing there. Talk a bit about the sectors we're seeing which are surging, and finally we'll wrap up with some companies we think are worth watching. So without further ado, let's start getting into it. I wanted to start with Forex because I think the Forex is so background. So I studied economics at university. So when I look at everything, I think for the UK specifically, Forex is really important. And the reason is that when we look at how our balance of payments works and when we look at how our economy works, not in what you see in a forex sensitive economy, what would happen is that, let's just say, if the pound gets weaker, we'd see a surge in exports. In our economy, because so much of it is services, that doesn't really happen. So when the pound gets weaker, what we see just a surge in prices and inflation. So the fact that so much the global economy is priced in dollars, which is why I've done this as a pound to dollar, means that as the pound gets stronger against the dollar, this is going to act as a downward pressure on inflation. So as a result of that, as inflation comes down, what it's going to mean is that it's going to mean that as long as we're seeing the right things in terms of growth and unemployment and inflation, all the rest of it, it's going to mean we're also going to get downward pressure on interest rates. So just announced today the latest GDP numbers, and it's come back that the UK has seen no growth in GDP in the last month. This can always be adjusted later, but the general sentiment is that the UK is slowing down, and that it might well be that there is the Bank of England looks to stimulate the economy through cutting interest rates. There's already talk of that happening in the US and in the ECB. Whether the UK cuts as hard as it's being forecast with the ECB and the US dollar is another question. But looking at the headlines, what we're seeing is that the UK is now at 2.2% in terms of inflation. USA is at 2.9%. Eurozone's at 4.3%. But where the room for pause is in the UK, which is maybe causing the delay in interest rates coming down, is on wage inflation, which is still at 5.4%. And obviously you guys in the industry would have seen this yourselves. When people are moving jobs, they want big pay rises. Cost of living's gone up. People want to see that reflected in their salaries. People aren't getting nice pay rises in their annual reviews. They're moving, etc. And that's just being reflected in the macro data. So even though the inflation is at 2.2, the wage inflation here is probably what's meaning that there's room for pause in interest rates. But once again, I'm going to loop back to the interest rates and into the Forex again. Part of the reason why this is also important is that the current forecast is that the UK interest rates, the UK Forex will continue to strengthen against dollar. And the reason that matters is that if over a period of time, the UK is projected to increase in strength against the dollar, where most assets are trade weighted to dollar, what that means is UK as pound strength against dollar means that by default, our assets become more valuable, which then means that as a country, we become more attractive to invest into just through Forex movement. So that's why what we're starting to see is we're seeing VC funding is starting to pick up as well as interest rates are dropping. And this is from PitchBook, this one. And what this is showing us is that this is they're taken from their first half of this year, their data. But what we're seeing is that in terms of deal values and deal counts, the forecast is for 2024 to be higher than 2023. Now, some noticeable deals that have just happened in the last month include Dockler, they're a virtual hospital. MirrorWeb, they run financial compliance. Dockler's 35 million, MirrorWeb's 50 million, both significant. The other thing that's quite important to note is that in terms of clean tech, and we'll talk more about clean tech later, but in terms of clean tech, Rachel Reeves has put together a national wealth fund, which is £7.3 billion, which is going to be directly and specifically for acting to stimulate investment into clean tech firms. So that's, along the way, we've also got M&A activity, which is happening, which will be resulting in further growth in the sector. So, for example, Security Alliance, their IT security firm, they've just been bought. Similarly, Wisneo, which are a talent solutions firm, have just been bought as well. And against all this, we've got to factor it against the overall market tide and the changing market factors. So, for example, Cisco, Dell, Intel have all announced massive redundancies. And it'll be interesting to see how that then ripples into the UK in terms of those. Because before I move into the job flow, I'll just finish with this point, which is maybe a serious one. But a recent survey by HR Grapevine there shows that 51% of the people who took part in that, who are HR people, are either implementing or considering layoffs at the moment. So the market's quite frothy. It's as a headline, that's quite a lot there to go through. But, in terms of economic talking points, growth is flat. We've seen the mini bounce, which has happened in the post-election, which we can see here. So where suddenly there was this deferred hiring, and companies just pushed. It's now gone flat again. We're looking at this year being roughly the same amount of job flow as last year. We're not predicting any major change there. But probably if there is one other little piece of good news, which is for the agency recruiters, what we are seeing is a significant slowdown. It's over 10% less corporate recruiter vacancies than last year. So what that means is companies have got the same amount of job flow as they did last year, but they're running smaller internal talent teams, which means that in principle, it should be good news for you guys. We'll see if that's the case. But once again, it's all about boxing smart and identifying where the key points in the market are for growth. So looking at the regional picture, what we've seen this year is that London has been picking up faster than the rest of the country. So just to explain this chart really quickly, so don't get lost. What we're showing here is by year, with 2024 being up to and including the end of August, total vacancies in the private sector. So when I say private sector, I mean everything bar charities and the third sector and government. Now, with that, we've broken it up into 4 regional categories across the north, which is everything from Liverpool through to Newcastle via Leeds and Manchester, obviously the Midlands, and then the south, and then London. And so what we can see that there's a couple of things which stand out for me here. The first is that the post-pandemic North Shoring phenomenon is real. So when we look at 2019, which is the first year which we saw last pre-pandemic business year, what we can see is that in 2023 the volumes were higher than in 2019, and in 2024 they probably will be too. So that's a permanent shift upwards. But the question is, will the North end up performing as well this year as last year? And speaking to people on the ground that I know, the feedback is that it's a bit more quiet this year, but I'm happy to take feedback on that one. Then similarly, with the South, then the question is, how much of that an uptick can there be there? Because 2023 obviously was quieter than 2019 as well. And will that start to pick up again? London was quiet, last year was quieter than 2019, but we're forecasting that this year London will return to 2019 levels. So overall, we're just seeing some rebalancing. London this year, as I said, picking up faster than the rest of the country. And like anything, certain regions are outperforming others. Looking at skills and demand. Now, going back to, I probably should have put this in there, but going back to what we saw in, say, 2019, we would have seen a higher percentage of roles here being for software engineering, and we'd have seen a significantly lower amount, which would have been for data analysis and data roles generally. So I think this is probably something you guys are all noticing, but data roles are becoming more prevalent. Now, the obvious point being that with the advances in AI systems and AI solutions are as effective as the data they operate on. So if we are operating with rubbish data, then the data the analytics won't be very good. So there's been a huge increase in roles around data analysis, data QC, data engineering, and roughly the ratio is for about every one AI role, there's maybe 100 plus data roles. So that's the kind of mix. And what we would see is we would be forecasting this to increase. And there's the big question. The other question with AI is then how that's then driving down software engineering roles. Now, in the first instance, obviously what we've had with the OpenAI, and I've spoken to developers who've told me about how now they can write functions in 30 seconds, not in 30 minutes, because they just put the right prompt into ChatGPT, and that's creating automation around open source languages like PHP and Python. The big question would be, given that OpenAI sits under the same trees, Microsoft, will they let the OpenAI start working on .NET? I mean, that would actually be quite considerable and would change the face of .NET development as we know it. I mean, that might already be starting to be happening behind the scenes, who knows? The same applies then with Java. Because obviously with any of these technologies which are proprietary, ChatGPT can only go for the open source stuff at the moment. But as that happens, we think that will shift through. And what you would start to see in the UK specifically is fewer roles, more senior, and then more automation, and where you're really seeing the pain points happening. And speaking as someone who has teams in both Poland and Ukraine, and I'm very well connected in both those countries in terms of their local IT communities, where you're seeing the pain point is in lower level IT outsourcing, IT development. That seems to be where the real crunch is coming in terms of AI. Anyway, so moving on. Just looking at the sector focus. This is keeping this one really simple. So this is just we're looking at banking, we're looking at tech, retail, consumer goods and services, and then the rest of the private sector. I can give you the whole list, but then the table goes on forever and it becomes a bit overwhelming. As we've seen, tech is speeding up, and a lot of this is linked to VCP funding picking up, and that's starting to translate through into hiring. But at the same time, retail is slowing down. Now, that's quite obvious in the UK. You've got the cost of living crisis, you've got other factors which are meaning that the sector itself is under pressure. And there are profit warnings from a lot of the retailers. No, there is, though, however, and I will say this, it's worth factoring the retail data, and it's only 8 months of data, and they will typically argue that their October, November, December are their best period. So you might well start to see a pickup in hiring there as the retailers get ready for Christmas, to get ready for Black Friday, all these kind of things. The Black Friday job spike, it's very clean and clear. We see a massive spike just around that time. So yeah, that could then end up altering the data a bit, but nonetheless, 8 months into the year, it's looking like retail is going to be like maybe 10 to 20% down even on last year. So it's hard to say. Otherwise with tech, I think the other key point is that this sector is just going to keep growing. Every industry now is now seeing its own version of tech, whether that's fintech, law tech, insurtech, health tech, biotech, every tech. And so it's slowly but surely going to merge. There's going to be a merge by sector with the various tech companies involved. And that's going to act to disrupt incumbents. And if I was looking at this, and I mentioned it earlier, The sector which I think is likely to see the biggest layer of disruption now is going to be in the UK is going to be energy. And so for people that follow the news, you'll be seeing that in the energy sector, there's been much noise about limiting the licenses for oil and gas, that the government have made a commitment with Great British Energy, which is in part to actually have clean, renewable energy sources. How possible their targets are is a separate discussion, but there is political will there, and where there's political will, there's going to be money, and where there's money, there's going to be hiring. So in the first instance, even what we would expect to see is we'd expect to see over the next 12 months a real bubble emerge around clean tech, especially as I mentioned, they put aside this funding, which is designed to work in partnership with corporations to actually drive jobs. The other sector, which is going to be worth noting, and that's why the data analytics investment into housing was quite an interesting one, is the partnership which has now taken place between the government, Lloyds Bank and Barratt Homes, which is all going to be about building out housing across the country. And so once again, where I see that being where what I would say is that will directly then link into prop tech. Prop tech will be more significant. People might want to do viewings, for example, without actually visiting, these kind of things. There are all sorts of aspects which prop tech can come into play. So I do think that tech will grow and it will fragment, and it will mean that by industry, by sector, the tech association will get larger, and companies that don't make that switch to technology are going to be left behind. And I'll finish on this point because I think it's a pertinent one. And if you want to understand this in a different way, let's look at the automobile sector. You know, you look at, say, Germany, which for a long time has dominated between BMW, Audi, Mercedes, and we've seen this shift with clean tech towards electric cars, and the German companies just didn't play fast enough. USA with Tesla is leading the way, but now the Chinese are ahead of them too, and they now have a real problem playing catch up. Now the UK retains some of the best investment schemes in Europe in terms of encouraging third parties, VCs and PEs to push money in. So it will continue to get the lion's share of the investment for the foreseeable future. But once again, if we're looking at where I think the biggest growth there is going to be over the next 12 months, I would say clean tech. Finally, I just wanted to give you guys something as our companies to watch. This is just to explain, it's a kind of report you can pull up on our analytics dashboard. But what we've done here, and just to explain this table once again, we've pulled up from companies up to 500 headcount, the total jobs they've had for IT roles from January to July, and then the total jobs they had in August for IT. So Intelerad, for example, they've had 10 vacancies in August against 11 in the previous 7 months. So there's obviously something going on there. And, you know, this is the way in which we're looking at the August totals and the percentages. These are all companies which would have seen significant surges in recruitment activity in August. So our guidance would be that even when it's summer holidays, the market's still busy, but you don't necessarily have to work that hard. You can just work smart from the beach and just pinpoint who you want to call. Zopa or whoever else, Feature Space, has 2 fintechs there on the list. So that's just a quick, and if you'd like to get a demonstration on how our portal works, you know, just let us know. But just wrapping up, because I want to keep this short and punchy and sweet, I would argue the macroeconomic conditions are favourable, if only because there's a political will to make them favourable. The interest rates will come down. At the same time, GBP is likely to strengthen against the dollar at least until the end of the year. After that, who knows? And what that means is that trade-weighted assets will gain value. Funding into the UK and VC and tech should continue to pick up. And it means that underlying conditions will be fine. How much interest rates come down will really be a function of wage inflation, I think. I think other countries will cut faster, but the UK has a uniquely high wage inflation problem. Looking at the regions, I'd say London is picking up speed. The regions haven't really seen that growth yet. And in terms of by role, I mean, development and engineering remains low by historical standards, but there's an increase in data roles, which I think will continue. And just to wrap up, going back to what I was saying earlier, banking and the financial services set to pick up in 2025. And a key reason why on this one is this is once again linked to the pandemic. You go back to 2020, and in 2020, what happened is that you saw all these PE firms pull together funds. And we're coming up to 5 years on these funds. And because of during the pandemic, none of them would have been divesting anything. They're actually rolling up and been deferring their divestments. So there should be quite a flood of M&A activity, especially in small cap, over the next 12 months. So the banking sector should pick up, which by default will directly correlate through to IT jobs. So, I mean, these are some of the hotspots which I would be looking at the moment. Thank you very much for everyone who has attended today. Appreciate it very much. In terms of our content marketing, every single month we're publishing reports. We're looking at trends in technology, finance, law, life sciences, insurance, etc. And what these reports do is they give you the ability to just read quickly, get a digest of what's happening. Equally, all the things I've been talking about today, all the charts, all the analysis, you're able to get from the analytics platform as well, and you can use that just to improve your forecasting and make your BD better, enhance your key account management, etc. I've got a blog. If you're interested in finding out more, you can sign up for that. And we're doing a special promotion for today for people who've attended this webinar. And what that means is that if you sign up today, you get until the end of the year, you get September for free. So that's a standard or a premium license. So a standard license, our salespeople explain to you the differences, but the premium license basically means that you can take our content and you can use it for marketing, which a lot of our clients like to do because it's turnkey content in blogs. The standard license means you get data access for internal use for BD and everything else. Anyway, so I'm James. This has been the IT Job Watch webinar for September. We're going to be doing this one again in October. If there's anything you'd like to know about more, do reach out. Or if there's anything you'd like us to include, which we didn't, then let me know. Or if there's anything you felt wasn't really very relevant, feedback's welcome. But otherwise, you can find us on social. You can find us on LinkedIn. You can find us on Twitter. You can find us on Facebook. Follow our page and also send me a connection request if we're not connected. Otherwise, look, thank you very much for listening, and I wish you all a very good day.